It is not possible that we are hosting this conference in Bangalore, the beating heart of India's startup ecosystem, and we don't kick off this event with a session on VC ecosystem. Today, India's entrepreneurial boom, be it groundbreaking tech innovations or disruptive, innovative business models, are very well supported by a solid and dynamic VC ecosystem. But what's next for the VC domain in this ever-evolving landscape? To unpack these questions and many like these, we have a stellar panel of industry leaders who will touch upon multiple aspects associated with the VC ecosystem. And to lead this conversation, please join me in welcoming our moderator for this session, Mr. Rajesh Sehgal, Chairperson, CFA Society India, and Managing Partner, Equanimity Investments.
Let me invite Sanjay first, who's right here. Sanjay Swamy is the co-founder and managing partner at Prime Venture Partners. A big hand for Sanjay. Early stage fintech, SaaS, digital India, gaming, healthcare, health tech, and other core areas of interest. And I think Sanjay is very well known in this ecosystem. Doesn't need a longer introduction, but a small one. Some well-known portfolio companies include MyGate, which everybody's familiar with, Neo, Dozy, Wheelseye, and Quiz. ZipDial and EasyTop were companies he co-founded, and exited one of them, ZipDial, to Twitter. I was a very lucky investor in the company. Thank you, Sanjay. Thank you so much. We exited that company to Twitter, and the other company he exited to Razorpay. I think more importantly, Sanjay is an Aadhaar and India Stack volunteer and evangelist. So big hand for Sanjay. Thank you. Great. Then we have Som, formerly Sompal Choudhury. Welcome. He is the co-founder and partner at Bharat Innovation Fund. Early stage focused deep tech fund. Three broad themes that they follow: deep science, hardware tech, advanced software, and AI. Portfolio companies include Nayam Innovations, which shape-changing materials is what the company does. Fire Compass, cybersecurity AI. Detect, which is industrial AI, and Algo Bio, which is molecular computing. I have no idea what they do, but we'll get to know more about when he talks about this deep tech stuff. So that's Som. We have another speaker, Naganand Doraswamy. Is Naga here? Oh, yeah. Of course.
This guy's a star, man. Give him a big hand.
Yeah.
Hey, buddy.
Good. So Naganand, the founder and managing partner, Ideaspring Capital, early stage science and technology fund. For anyone who's been involved in the ecosystem, early stage ecosystem for a long time, Ideaspring is one of the early players, very early players, backed a lot of companies. I think if he starts talking of companies he's been involved with, and I think Sandeep has some experience here as well. So thank you for being here. And we have Nitin. Nitin Sharma is founding partner at Antler. Of course, again, anyone who's involved with very early stage, 0 to 1 or even -1 to 0, I think that's you have to have come across or cross paths with him. Founding partner at Antler in India, leading global investor focused on the pre-seed and idea stage across sectors. Nitin has been amongst the earliest investor in startups like Kutum, Third Wave Coffee. Is Third Wave Coffee sponsoring us or not?
You should have told me earlier.
I love their coffee.
One for everyone in the audience.
Yeah. Vyapar, Inspecity, and Namayatri. So those are his company.
Is the not aware.
So great. Thanks everybody. Thank you guys for being here. I think I'll head back to joining these guys and start off the conversation. So there are a few areas that we thought we should touch upon. I know 60 minutes is a very short time to really have deeper conversations on topics. But at the same time, I think 60 minutes should be sufficient for us to really pick their brains on a variety of things, variety of parameters, aspects that are really relevant for anyone who's trying to understand early stage investing or early stage startups as a founder, co-founder, investor, etc. So few areas, I'll just lay it out there and then we'll, it's a free-flowing conversation. Whoever feels, really more for that topic, please go for it. One is funding trends. I mean, no VC panel is discussion is complete without talking about funding, domestic versus international, happening, not happening, is it sufficient, etc. So something on the funding side. Then we will also talk about valuation and valuation dynamics. We've all come off the whole euphoria of 21, 22, and then after that, the whole winter that we talk about. So what's the status there? Have valuations, the inflated valuations, have they corrected, appropriately, too much, little? We'll delve into that. Regulatory environment. I think whether we like it or not, the early stage ecosystem, startups, etc., have had both help as well as problems with the regulations. And I think some of the people I know here are very active in terms of their voice against this should be changed, that should be changed, let's do this, let's do that, at various forums. So we'll delve a little bit upon, let's say, ease of doing business for startups and for VCs or investors. Technology, I think we have a deep tech, person here. So, all deep tech related questions should go to him. But I think it's important for us to understand all these, labels that are thrown around nowadays for anything and everything. AI, deep science. Yeah, AI is like, we all know what is AI. But I can guarantee you in my conversations with a lot of people, you go 1-2 levels below and you have no idea. There is no deep conversation at that level. But superficially, we all are using AI. We all know AI. We can talk about AI for 5 minutes, 10 minutes, little bit. The conversation starts drying down, and after that, it's like. So we will delve into that as well. A little bit about technologies, exit strategies. Sandeep in his introduction mentioned there's a panel on exits and all of that. And I think for us as investors, extremely important to exit, and so that the capital can be recycled and all of that. So these are the areas we're going to speak about. Let's start with the funding trends. Who would like to go first? Your views, problems, good things.
Senior, I think the earliest stage will be the one. Mainly because
Nitin, yes.
Mainly because regulation, exits, etc., is a bit further away from my stage. So, funding, I'll just share some comments. I'm sure others have a lot more color as well. India venture, if you just think about it, if you look at sort of where it was in 2014 to 2024, like just look at 10-year period, we were at about 1.2 billion, 1.5 billion or something in 2014, and there were 3 unicorns. First unicorn was 2012. By 2014, there were 3. Fast forward to 10 years later, last year, the volume was something like $12 billion. And there are probably 100 plus unicorns, although we can debate whether many of them are zombies. So somewhere between 70 and 100, 110 unicorns or so. So now I point that out because to the outside world, it feels like, okay, it's been such a drop, right? So in 2021, the peak, India took 40 billion, right? So we went from, let's say, 1 billion in 14 to 40 billion in 2021, right, during the COVID boom. And then we crashed to half of that in 22 and another half. And then we've kind of come back at about 12 billion in 2024, last year, right? So if you look at just the recency, it looks like it's still very much down from the peak. But I like to take a very historical view of things. If you look at a 10-year period, we've grown 12 times, right? So as an ecosystem, the funding has continued to expand. And this is just, these trends are very much similar to sort of the global funding volumes. The year that India had 40 billion, the US had something like 350 billion, right? So India is still about 10% of the venture money that's in the US. And I'm keeping growth and private equity, that kind of volume out. I'm just talking about venture.
And I think we have to all be careful about not conflating luck with skill in this business. Right?
Yeah.
The second one is good companies never die of starvation, but can often die of indigestion. And that's something that also we have to be very careful about. Just because somebody came and gave you $100 million check at $1 billion valuation, it's like going out there and having the amazing breakfast buffet that's out there. Right? You can't have all of it just because you can, in theory, afford to have all of it, right? So I think we saw a lot of that happening. where every company decided to go full stack and build everything and build a fintech loan department for their customers so that we could actually, buy that extra sandwich on Swiggy because that's what we needed when we didn't have the money, all of that stuff, right? But as times go by and when a startup does well, only when it focuses on doing one thing better than everybody else, right? And it's a risk. It is not meant to be a guaranteed success, right? So I think that culture has now come in, and that means that founders are saying, okay, what am I really good at and why should I win? What's my right to win? And focus on what is the right quantum of capital to raise at fair terms.
Yeah.
Right. I think those two sort of have translated to founders who are not seeing this as a money-making exercise. Financial success is an outcome. It's not a goal, right? I think that's what defines true entrepreneurs and true VCs as well.
True.
Right? I've already taken all the domain and stuff like that, and I've written the outline. Someday I will get around to writing my book about this. It's what my partner told me, Shripati Acharya told me on the first day when we started Prive. Said, Sanjay, I hope you know we are signing up for a get-rich-slow scheme. We have proven the slow part. Now I'm hoping we'll still prove the other part. But that's something, that is a mindset one needs to.
Quote of the day.
Yeah?
Quote of the day.
I've registered getrichtslow.vc, by the way. It's very true.
So just to add, look, cycles are going to be there, right? Because we have been in the industry for 35 years. We have seen 5-6 different cycles. You think you have gone through, you have learned, but 7 years down the road, everything is forgot. So I think if you're playing the long game, you have to somehow be prepared to deal with cycles.
Absolutely.
Because unfortunately in India, at least early stage is not gone out of control. Even during the peak, it was those guys who are doing Series C, Series D. There was a lot of money and people running, with a lot of flush cash were going after it. But at least many of us here are early stage VCs. In our case, there was valuations were always reasonable, right? It never went out of control. So people who had to worry about or late stage VCs or private equity guys, who kind of went bonkers.
Yeah.
But that is, I think, self-corrected now to a large extent. But even if you look at that in AI, like for example, there's a huge wave in AI.
Absolutely.
We just finished SaaS, but AI companies are valued like crazy. So I think that's part of the life for us now. You just have to get used to it and manage it appropriately.
Excellent point. Yeah. So if you look from a valuation standpoint, compared to say 21, 22, especially in the Series B, C stage, right? The typical SaaS multiples, so forth, it was 20, 25, 30x, whatever, crazy numbers. Those I think have definitely come down, right? We typically invest in pre-Series A, Series A. When our companies raised funding in 2022, right? It was still, we have seen like 20, 25x kind of multiples very common. Now when they go out in the market, right? Showcasing even a 2x, 2.5x growth, getting to a 10 to 15x sometimes gets challenging, right? So it's an order correction. So I think from a Series B, Series C standpoint, that's when Naganand mentioned, right? It went crazy. Those corrections have happened. In the early stage, I'll give you some numbers. 2018, when we started our fund, we even got in at a 4-5 million valuation at a seedish kind of a level, right? Now, if I look at those kind of similar stage companies and so forth with very early product market fit, maybe one customer, zero revenue, the numbers have gone in the 8 to 12 million, 15 million kind of range.
And if there are no customers and they came out of Swiggy, it'll be $45 million.
Exactly. If this is a second time founder, yes. Right. So, but again, to a certain extent, Naganand and me, we play in a bit of a deep tech, deep science-ish play. Not too much competition as yet. Yeah. As yet. This is India. You will get competition. But yeah, you say competition is good.
I'm updating my website as we speak.
Stay in fintech, which you're very good at.
Yeah.
If you work with founders, I'm sure they're already putting AI everywhere in their pitch decks. So the only two comments to add. I think the right sizing or rationalizing of the ecosystem seems to have happened in the sense that you work backwards. People have realized, okay, India may have smaller IPOs and that's fine. We have to be far more capital efficient and that's important. which has also meant that working backwards, some of the funds which have been around for a while have also realized that there's no point in increasing fund sizes beyond the point. It's more important to sort of find your game and play it again and again. So some people are, I think, moving away from just a pure AUM game, not everyone. And then I think the way that translates back is, except for AI, I think there's been far more sort of reasonable pricing and perhaps even unfair in fintech, where the regulatory risk has started to weigh so much on the discussions. But in AI, and I think that I don't know if my panelists, fellow panelists here agree, but I still feel like we are not, as an ecosystem, appreciating how big of a deal this is going to be. And it's not like the last 2 or 3 cycles where there was cloud and mobile, etc., and valuations went up. I mean, this is, I was very young when the dot-com boom happened, but that's the only parallel, right? So this is one in a 30-year kind of thing, which will change every industry, every workflow. And I still think that we are lagging here, in the sense that if you look at what's happening in the Valley, in a good way and a bad way, right? The bad part is, the good part is that we haven't gone crazy with the valuation numbers there, right? I mean, if you look at an average seed in Silicon Valley right now, has just shot up to 30, 40 million. And that's not happened in India yet. But my worry is that that is not too far away. I do worry that we're all going to get caught up in the frenzy again, because that's human behavior. But the only good thing about this is some companies are just showing trajectories in increase in their revenue, which are unheard of. So maybe for some of you have heard of Cursor types of companies, gone to 100 million run rate in 12 months. Right? We have a company called Lovable, which has gone to 17 million in 3 months in Sweden, not in India. So I think for all of us, the exciting thing is also finding some of these kinds of companies where no business model, I mean, SaaS companies and many other companies had crazy trajectories, but some of the things that we are seeing in AI worldwide are crazier. So that could be a huge positive and negative in terms of the valuation frenzy.
Yeah. So I think one thing which distinguishes the public markets and private markets is the term called profitability. Right? On typical VC deals, etc., compared to larger private equity firms or public market investments and all that, there's a lot of complete focus on profitability and profit metrics. Not so much in our ecosystem. But over the last 2-3 years, we've seen at least some conversations that investors are having with their portfolio companies, etc., or potential companies on a path to profitability, if not profits, right? So some comments on that. Are we now saying, and this whole dynamic between growth and profitability, right? So if you want to become profitable, which means if you want to show profitability, you have to sacrifice growth. So are they mutually exclusive, or where is this ecosystem in terms of these two parameters?
So I think there are 2 aspects to this profitability. And then, if you take the startups and split them into 2 categories, one is products, one is B2C, right? B2B and B2C. B2C, I think, has a very different set of metrics, and I have no understanding of that. Probably Sanjay has some in his portfolio. He can comment if he has.
But I don't understand.
Right. But B2B is very different. So B2B, I think, first of all, the amount of capital you might want to raise is a lot lesser compared to B2C. Yeah. And in Series A, you can start seeing some capability in terms of, okay, when can I hit profitability? Because you're selling, your team size is small, your marketing is very focused. The sales cost might be higher than the marketing cost because your marketing is very focused, right? So, yeah, even at that time, you'll have to invest to grow. Geographical expansion is where you want to spend, but you can be very frugal in all those calculations. So in B2B, I think, beyond Series A, you should get into profitability and then look at those aspects. And then by Series B, if you're not profitable in the B2B, there's an issue, right? Because you have to be. Whereas in B2C, I think the game is very different. Because the amount of money you have to spend in marketing is huge. So I don't manage those, so I have no clue. Even in Series B, it might be a difficult work in profit. But the question, I think, there is, for how long will you start pay to acquire customers? Right? Yeah. When do you stop paying to acquire customers? I think that's a question that needs to be answered at that time. But not much visibility. I'll hand over to Sanjay.
So I think in both cases, similar rules apply. The scales might be different because the size of the opportunity is possibly quite different. But I think good companies
are always keeping an eye on the unit economics, right? There has been a lot of random accounting, right? I buy a book for 90 rupees, I sell it for 120 rupees. I listed at 120 rupees, but I buy it for 100, I listed at 120, but I sell it for 90, and I claim that the 10 rupees of loss is going to be amortized over the lifetime value of this customer, and this customer is going to spend 4,000 rupees with me. So this actually made profit on the first transaction. That is rubbish, right? And I think those bad habits were there for some period of time. I think now everybody is starting to get a lot more conscious about contribution margins at various forms, CM1, 2, 3, whatever the definitions are. I can never understand them. But ultimately, I think, it's about cash flows, and that's what businesses will get valued for, right? So eventually they all, if in a successful case, are converging into the public markets, and you will be treated the same way on financials by the public markets. Obviously, the brand cachet, which should translate to pricing power. Brand cachet, which should translate to stickiness of customers, right? An ability to attract more customers. That may have a premium, but the cash flows and I would say the unit economics are always going to matter, and that's what will drive the bottom lines of the companies, right? So it's a different journey maybe, but they will converge at the same thing in a successful situation. There is probably a little more appetite to say, okay, this is not the priority right now because you got to win in the market, because these are, I wouldn't say winner takes all, but there will be 3 winners in a large market, and you need to be 1, 2, or 3, otherwise it's irrelevant, right? So I think that's the I wouldn't call it gambling per se, but that is the appetite one needs to have to be able to go after a big outcome.
Yes.
In a short period of time. And that's why I even tell people, even venture capital is not the right investor to get depending on the trajectory of your company. If you're never going to be able to deliver outsized returns by smartly leveraging capital in a short period of time, you're better off not taking venture capital. Build at your own pace. There's nothing wrong in it. Bootstrap companies have done very, very well. There are great examples of Shopify and others that were rejected by all the VCs that have become amazing companies. It took 5 years longer, right? And in hindsight, all the VCs are looking stupid for having passed on that opportunity, right? So these things will continue to happen. There's no magic formula in all of this. But I think, disciplined execution is what separates these companies. Right? They may appear on the outside, like Cred might appear to be blowing a lot of cash. Swiggy might appear to be blowing a lot of cash. Internally, there is a method to the madness, and there is a plan, and they are probably hitting all of those metrics. You may not be comfortable with what those dashboards should be, but I don't think, I think the days of free money saying let's just go think outside of the AI space are gone.
So I think it's safe to say that value versus valuation is, until the next madness sets in, we are holding. Yeah. So when the next cycle comes, all this there will be memory loss again.
Yeah. So before the next cycle,
We all have amnesia.
before the next cycle hits us, I think it's important to understand exits. Because what you invested in the earlier cycle, are you able to exit, etc., etc. So just some thoughts from you on what are the exit avenues that VCs typically have? How are they? Are they healthy? Are they available now, or they're just theoretical constructs? Whether they are, secondary sales to other larger investors, strategic sales, IPOs, M&A, etc., whatever.
Yeah. So I'll get started. Just again, we are more investors in a couple of deep science kind of bets. Larger part of the portfolio is what we call advanced software and AI. So we are seeing 2 distinct aspects to it. On the deep science area, right, from an exit standpoint, what we are seeing is as soon as they reach certain milestones or certain thresholds, say, for example, a biotech company gets through a successful human clinical trials, right? Or one of our materials companies is proving some certain outcomes, that's when the valuation does a significant step jumps, and it could be anywhere from 7x to 10x jumps, right? And that's where more of the interest from global investors or from global M&A kind of comes in. Okay, so this is on the deep science bets. On the advanced software and AI, this is more enterprise techish, right? Me to me. And that's when I think we are getting, and most of our investments, we focus on very differentiated technologies, very differentiated IP. And say, for example, 16 of our startups have filed close to 80 global patents now, right? So we are seeing interest from an M&A perspective, and I'm coming to the IPO. M&A perspective, primarily from the global strategics. They're coming in and eyeing the technology, right? If the technology gets to a certain, couple of million, $2, $3, $4 million of revenue, they're willing to bet on the technology and acquire them. The next stage happens if you get to a 10, 15-ish million kind of revenue, you start hurting some of their customers, right? Getting some client. That's when they're willing to pay the big bucks, right? 100, 200, 300, 500, whatever. So that's kind of the trend what we see from some of our companies. From an India market-centric standpoint, we have one company, PlayShifu, right? Which has been in the very interesting augmented reality educational play with toys, right? So that's a company doing incredibly well in both in the global markets and India markets, almost near profitable. So those kind of companies, we'd love to do an IPO in the next couple of years. Got it.
So maybe I'll go next. We've had, I would say, a fair variety across the board, but this is also a business where I still think I've not seen the whole back end of a full fund life, right? So to comment on how everything will shape up. Ultimately, this is a business where whether you like it or not, 3 companies in the fund will determine the outcome. And all the others, while they may be meaningful outcomes for the founders, are really not going to matter to the fund, this thing, right? And as they say in this business, you make your money on the winners, you make your reputation on the ones that don't deliver actually the financial outcomes, right? So we've had several situations across the board where we've had a company sell for $5 million, which probably made nothing meaningful to the startup itself, but also had in the same fund for the same dollar of investment probably something that was more like a substantial multiple, like a 10 to 15x bagger on our investment itself, right? And of course, we have to respect and treat all founders exactly the same. That it didn't work out is just a matter of how things worked out. And so that's actually where a lot of VC time goes, just to the earlier point. But when I talk about, you need to be patient to put in 3x the money, for a 12-year period of time before you start seeing returns, that's not entirely true. That's what you should be ready for. There will be some nibbles that will keep coming back, and hopefully you get back the first fund's money before you have to deploy the third time, etc. And that's the practical reality of what the VC, the manager, aspires to do. And that comes through a combination of smaller M&As. It may come through smaller exits where people might come early and acquire this company, or people might come a little later and buy it for some meaningful amounts, right? We've had some of that. But I wanted to talk about another tool that's there in the armor of a VC to ensure that we get liquidity to our LPs, which is the concept of secondaries, right? So along the way, when you're holding a company, and that's why ownership, we believe, is probably the most important thing in the VC game, because again, you can only get liquidity in your best companies. You're never going to get liquidity in a company where you hold 2% and it's not going anywhere, right? The 2% that you hold in a winner is what's going to matter, and that's when you regret having 2% and not 10%, right? So that is how this game is played, and you have to have a meaningful ownership to be able to drive liquidity, because what you don't want is selling the 2% that you own in a company at $100 million and 2 years later it's $2 billion, right? And that is where the balance comes off. But if you had 10% in that company, you could sell the 2% at the 100 million valuation and still ride it out, right? So that comes to sort of strategic portfolio construction. Secondary opportunities arise in companies when they are typically raising next rounds, when they're doing very well, and somebody comes in because a large fund is coming in, like in an example of a deep tech company, it could be someone, let's say a Google Ventures or a SoftBank or a Tiger or what have you, and they have always got the appetite to put in more money and to build more ownership, right? So typically what happens, you first ensure that the company has raised the capital it needs, And then if there's overflow, perhaps there might even be some liquidity one gets to the founders. I have a lot of thoughts around that, but at least something reasonable so that they can exclusively focus on building the biggest company that I've always been supportive of. And then there is an opportunity for funds like us to go in typically and get some chips off the table, right? So that is one vehicle. At the end of the fund, and I think is Alok Gupta here yet? Not yet. Okay, he's speaking in the afternoon. We have actually done a transaction with Foundational PE, is where there are funds that are specialized in coming and buying out people like us at the end of our fund life, because we can't keep going on forever and ever. We have commitments to our LPs, and yes, they will take probably a discount to the NAV, but they will also come in there with a large check, buy out the LPs, and then they will continue to hold. Now, the GP might continue to hold. GP is the VC funds, or the GP might also exit, or some partial combination of the two. So there are a lot of other avenues as well, and I think some of them are going to speak. So this is an industry in itself. This whole getting liquidity out of your startups, getting in is one part of it that we romanticize a lot about. But the exit part of it, I'm starting to learn now, is actually quite a science.
Yeah. So just to add to Sanjay, there are 4 cycles. If you look at our VC life cycle, there's raise capital, invest capital, grow capital, exit. My opinion, exit is the most difficult, toughest.
Toughest. There's a joke, which I usually repeat. How does any VC enter a room?
Yeah.
It's facing the door.
Yes, the exit.
Facing on the exit.
Right. And it's very hard because to exit, you need to find the right partner, and there are not that many right partners for you. The funnel is very, very thin when you want to exit. So we all enter at least when I enter the VC world, it's that exuberance, and we'll build. Our goal was to build companies. Didn't realize how difficult it was to exit companies. Now, the thing that keeps you going in terms of the outcome is really truly the exit.
We need to exit this panel also in a few minutes. So let me take some few questions. Yeah. And very interestingly, there's a name that's repeated in 3 questions that I see. It's called BYJU's. Right. I'll read the question.
That's been an educational journey startup for all of us in this ecosystem. Yeah. Next.
There's currently looking at a VC ecosystem, especially with startups like BYJU going bust. And combine this with the other question about BYJU's, and I think they're interlinked, is the why and how. How did private markets, fuel BYJU's rise and fall, impacting the entire sentiment, etc. And I think importantly, what key lessons can investors learn to prevent similar mistakes? This question is from Darshan. So Sonam and Darshan.
So I'll take what's the reception we are getting from the LPs globally, right? Negative, very negative. I think, what we hear from some of our LPs that, many of them came during the 2005 to 2010 period, right? Mostly in real estate and private equities. Yeah. Okay. They got burned heavily, right? And obviously, last 5-10 years has been a bit of an euphoria model, right? The VCs, the funds and LPs that I talk to, they are questioning us, right? What kind of actions have you guys taken about your portfolio companies? Why did this happen?
Yeah.
Will it continue to happen in India? Right? The reputation has been globally tarnished, right? Bottom. So obviously, all of the VCs, everybody, we are trying to put in a microscopic lens on, with all of our startups, multiple audits, multiple pieces.
Sure.
But it is what it is. Few guys have said, hey, is this the reputation of India? Is this continue to happen? Right? I've had multiple questions faced like this as well. It's not a good sign. It's not a good sign.
Definitely not. So what are the key lessons that, we can take from the BYJU's episode? I'm not, we're none of us are insiders into BYJU, but as an ecosystem, we're trying to get difficult questions. So I'm not answering. As I said, I promised in the beginning, they'll answer the difficult ones.
I have a slightly different view that, maybe because we're not out raising right now also, but there's always the, not to stock glass half full, But there is always the other aspect of this, which is everything is relative. So there are concerns about India, but if you're an international investor, and again, I think the biggest challenge right now is the flush of money going towards Silicon Valley again in AI. But if you keep that aside, where do you deploy? BRICS used to be a thing. It's basically dead, right? Somebody told me the other day, you know, India got 12 billion last year, right? How much did Indonesia get? Remember, we used to have, Indonesia got 400 million, right? So all of these other markets are not great places either. So I think growth capital will continue to come to India. It's just
And not to mention, you dare not invest in China. If
Yeah,
you're a-
China,
if
where
you're
will you
if you're
invest?
a US
Brazil.
university endowment.
China, Russia, Indonesia. So India is relatively a bright spot. So that not to say that cases like BYJU's don't matter, but I also think that maybe it's there have been many such massive flare-ups in Silicon Valley as well. So
Theranos.
Theranos, WeWork. I mean, obviously we can find examples like that. So
Sam Backfried.
yeah, FTX, etc. So
Web3s.
I think that this is just the nature of markets with cycles, and if you see enough cycles, you're not surprised by anything. And the problem with that space was that most of what was being sold as ed tech was neither ed nor tech. So the problem was in the business models and lack of outcomes, and which drove that kind of. But the story was very different, right? And the only other thing is, if you look at a common thread, a lot of these rounds were done in 2020. And I remember somebody mentioning in 2020 that, all of these investors who are doing these massive rounds, because of the sudden flush of monetary easing, they were just not even doing diligence. So we have $300-400 million financings being done on Zoom, right? And in such a frenzy, obviously DD had to suffer. So I don't think it comes as a surprise that rounds done in that 6-month period, everything on Zoom and everything in 5-day decisions was going to end badly.
So let me summarize this answer.
Just to add,
Yes.
when you speak to international investors, they have options all across the world. On Nitin's point, right? And then we have to stand out.
Yeah.
The bottom line today is India is still not standing out.
Yeah.
Okay, that's a true reality, right? When it comes to VC, there are not enough proof points, and we'll have these jolts along the way. But if the delivery is happening, then these jolts will be absorbed. Yeah. The problem happens when you're not delivering and these jolts will come, then it takes you down even further. So I think as a generic, even as a VC asset class, we are still ways to prove, and we have to work hard to prove that, right? So then sentiments will start to increase. If you go talk to people outside, to Som's point, in the general feeling is still, as an asset class, India is still mature. Like what China attracted, 10 years ago, you're nowhere close to that. Not even close to that, right? So I think we have our journey still to play out.
So to summarize
Second
this
part
answer,
of your question, to your question, Rajesh, which is what are we doing about it, right?
Yes.
I think every VC has beefed up their finance and compliance team.
Correct.
Not just for the fund itself, but really, especially the early stage ones, right? Going and sitting with the founders or sitting with the thing. Look, incompetence is always something that is probably grounds for firing, but can be accepted. Intent cannot.
Exactly.
Right? And so we have to make sure that we can trust it. That's why, of course, we had a lot of silly things like no diligence, doing a one Zoom call and giving a $6 million check over 15 minutes because your kids were in the back saying this has happened to one of my companies. Saying, do the deal, Dad, do the deal. So you did the deal, right?
Yeah.
And it actually feels terrible even if you're a founder. Even I as a VC, I don't want an LP walking in over a coffee here and saying, okay, let's back you for $10 million. I want them to do the thorough diligence and be totally convinced, right? And so I think rigor and diligence at entry, reference checks, which are very poorly done, I have to say, in this industry. I give you, Naganand will be my reference. In the 5-minute conversation, of course, he's going to say good things about me. Sure. But if you spend an hour with him, he probably has a lot more to say. And for that, you got to win his trust. And that's the investment we all have to make when we do reference calls on people. Sure. You can't just, it's not a checkbox item, right? And this is the discipline that, at the end of the day, in our ecosystem also, or our LP's ecosystem also, people just have jobs and they have OKRs to deploy capital. When you have that kind of an OKR, it's a bad thing, right? So I think this is where, I'm sorry I'm taking a little extra time on this. There has been a lot that has happened. There was also a wave of about 5-6 companies like Go Mechanic and all of those also where there was a lot of this happening. I'm not saying it is not going to happen, that it's never going to happen, but I think we've all tightened the screws and it's up to us now. But thankfully, this is where AI and hopefully some of the companies that are being incubated in Nitin's workshop there are going to come out and actually make it a lot easier and make it harder for people to be, to be.
I agree. You should all fund them.
Yes, absolutely. Bring them to me.
If you want to fund him, you need 1 hour with him first. But I think what we are saying is few things that came out of this conversation. One is TINA, Tina. So you're saying there is no alternative. Where will the money go? I think that's one way to look at it. The second is there was serious corporate governance lapses, and we are all agreeing on that. That's not the end of it. It's buyer beware. You will have these kind of it's emerging markets. It's not just India. Emerging markets are emerging for a reason, and I think corporate governance will remain a challenge. It is a huge challenge. I think we face it with our portfolio companies on and off, and you hear so many other stories, etc. So I think that's the other thing that comes out. And third is, VCs have tightened their systems, their processes. We are doing far more than we were doing earlier as an ecosystem to make sure that things are as they appear to be and they are in order.
Good companies don't die of starvation, but can die of indigestion is exactly the quote for that one.
Yeah. I think one last thing, if you can touch upon quickly, there are two areas that we haven't spoken much about. One is the deep tech or the tech part of this whole conversation, and the other is regulatory affairs and the regulatory environment. I think let's do the easier one, the regulatory one, quickly, so that we will have a couple of minutes for the other one. So regulatory, how
I have a measure for how good the regulatory environment has come, and that's not about ease of doing business and starting a company and getting permission in 3 days instead of 3 weeks. All that is irrelevant. It's the shutdown process. Right? I'm glad to say we actually got our money back from a shutdown very quickly this time, because the reality is, 6 out of 10 companies will probably shut down in the life of this, right? And it used to be a nuisance to have your name, not being struck off as a director of this company for like 10 years. It had to be 3 years of, no transactions in the bank. The founder has no incentive, has moved on, and suddenly you're stuck with that, right? So I think that is, in general, something that we have noticed that has gotten a lot better. Of course, in fintech with RBI, I actually am very comfortable with RBI's approach. I think RBI has a clearly stated intent, and basically it says, look, now the roads have been built, the lanes are there. If there is a traffic jam, you cannot drive on the shoulder. In the past, it was kind of okay to drive on the shoulder to get there, and people got away, but no longer, right? And so I think you have to appreciate the spirit and the intent here. The consumer cannot lose money when it comes to all of these things. Now, it will mean that it's not the wild or the wilder east, if you think about it, and companies will have to be built at a certain pace. This is financial services we're talking about. But if you stay disciplined about it and follow the rules, in my view is if it's not white, it is black. There is no concept of a gray area in this business. Big companies will be built, but you got to be patient.
Yeah. So on deep tech, let me ask us very specific. Let's make it specific. AI. Everybody's talking about it as we saw, and there are questions around AI. So what is the key advantage that India brings to the table as far as AI is concerned? Is it going to happen here? Are we going to be the creator of it? Are we going to be the consumer of it? Are we going to just follow the US? What should India be doing?
It's all. That's a pretty difficult question, but I'll give you my thoughts. See, at the end of the day, it's a massive euphoria, massive amount of capital going in. So if you look at just the 3 layers of AI, right, frankly speaking, from a hardware, systems, data center level, it requires a humongous amount of capital. We have probably seen close to a half a dozen AI accelerator, AI semiconductor companies. But again, nothing compared to what we have seen in US.
Yeah.
And it takes a humongous amount of time, resources, and energy. Right. So we are not going to be playing big time in this play. Right.
Exactly.
If you look historically, if you look at IoT, if you look at data analytics play and so forth, we have not really played either in the middleware or on the bottom layers. It has been largely applications.
Yeah.
Most of our early AI startups that we did in 2018 and so forth has been on the application. So yes, you pick up a vertical market, you have data around it, right? You use all the goodies that have been developed, the cloud, the data analytics platforms and so forth, and build very verticalized AI models and so forth, right?
Excellent.
What we are now seeing, though, in the Gen AI space, a number of companies are coming in the middleware level as well. So that's a very positive sign, right? Not too much in out below, but applications and as well as middle layer, at least few layers of middleware we are seeing. Right. And many of these companies are, frankly speaking, cross-border startups. Right. One founder here in Bangalore, one founder either moved to Bay Area or resident out of Bay Area. So we love those models.
Great.
Excellent.
So I think just to add, the biggest problem I'm having as an investor is to figure out where the differentiator is, right? When a startup comes, why will you be still relevant 2 years, 3 years down the road? Trying to get a estimate on that, to me personally, that has been the biggest challenge.
And it's changing so super fast.
That's the whole
I jokingly, I say there are two things I read up every morning: what has Trump done and what is AI?
Today morning you would have a lot of...
So this morning, always two things I read, because if something has happened the previous night, when I was asleep, something changed. These two things I've constantly
expectations last night.
So Rajesh, just one 30-second plug for one of our portfolio companies. There's a company called Dozy that has built an extraordinary deep tech plus AI-based solution for healthcare. It's an early warning system. Every hospital in India that's used it has said we're getting zero code blues over an extended period of time now. Excellent. And is now expanding to the US with FDA approval. And there is nothing of its kind in the US as well, right? So while at the Gen AI space and at the platform level, one might argue that we're not going to have stuff, I think the moment you peel the onion back a little bit, there are going to be some extraordinary companies out of India. I also think that we're going to start seeing the early days of enterprise software, SaaS applications actually being able to monetize in India as well, which had not happened in the past. Right. I think historically we always said TAM is $10 million, done. But because of AI, it's actually going to be able to solve problems where people are not going to be the first choice in India. Don't ask me what that's going to do from an unemployment perspective. Sure. But this thing is going to behave, it's going to work 24/7, and it's going to do things in a consistent and reliable manner. And that, I think, is going to also create tremendous opportunities here for tech startups.
Thank you, Sanjay.
Perfect time.
Thanks, Som. Thanks, Nitin. And thanks.
I just wanted to say one thing, which is for all the audience members are in finance and accounting, and please pay attention to what's happening and just be very, very aware of the new tools coming out. I mean, there are already lots of financing happening with AI tools that will make your job 10x easier.
Or go away.
So I think, well, that's not what I wanted to say. But it's both actually, right? So I think the way to look at it is what can you do with these tools which makes you 10x better than one of your peers. And if you don't, then it's going to be a huge challenge.
Yeah.
Yep. Thank you. Start using them.
Thanks, everyone.
Thank you. Thank you so much.
Thanks to our expert panelists for shedding light on the dynamic and complex VC landscape in India. I'd like to request Rajesh to give a small token of gratitude from our end to our panelists.